agreed on the holistic framework, which was designed to provide a way for global risk assessment, a set of supervisory requirements for a forward-looking analysis of risk, and a range of policy measures with a macroprudential perspective. So three elements: a framework for global risk assessment, a set of supervisory requirements, and a range of policy measures. Over the last 3 years, we have focused on operationalizing the global risk assessment framework, the first element, which we call the global monitoring exercise. We use the acronym GME. And we also have focused on an assessment of the comprehensive and consistent implementation of the global macroprudential standards, the supervisory requirements that we have embedded and developed as part of ComFrame, but that have a particular macroprudential perspective, the supervisory and policy requirement, as this is the key to the effectiveness of the holistic framework for mitigating systemic risk. I'm pleased with the progress we have made so far, and I can see real benefits from this framework in our ability to better understand the risks in the global insurance sector. And this has been actually, and not by design, but by fortuitous chance, really, that the development of the global, particularly monitoring exercise, the risk assessment framework, which we developed as one of the three elements, as I said, of the holistic framework for the assessment of systemic risk, has actually proved very useful, almost invaluable in our risk assessment more generally, particularly that given that since the development of the framework in 2019, we have been facing a number of shocks, and most importantly, the pandemic. As chair of the IIS Executive Committee, I have also been pleased with the collective discussions we have had so far since the framework was established. We had one in 2020, one in 2021, and the 2021 was a little bit more limited, given that the data collection that we had made was focused on assessing the risks from the pandemic and was more limited than the broader assessment. We had a collective discussion in 2021, which was a full discussion based on the full set of data. And we're planning to have a third one in the autumn this year. Now, what do we do in these discussions? We focus on two things. One, a set of global insurers, which we identify using systemic risk criteria. And also, so this includes quantitative criteria, but also supervisory judgment and the discussions that we normally have in the early summer to actually identify the set of global insurance that we are going to be discussing. Now, this collective discussion of the set of insurers does not mean that the set of insurers are systemically important individually. It is a set of insurers that display certain characteristics and that actually merit collective discussion in September. And as I said, we use both quantitative criteria and supervisory judgment. Now, together with a discussion on the set of global insurers that we agreed to discuss in the summer, we also agree a set of macroeconomic themes that are confronting the insurance sector as a whole, and we look at those as well. So the collective discussion, as I said, has two parts. One is the discussion of a set of global insurers, and secondly, the broader macroeconomic themes. And both of these things are equally important. And I can report, and I'm glad to report, that in the two collective discussions that we have had so far, based on this approach that I've just described, I was glad to see a richer and fuller discussion that I think made us all feel at the end of it that we have had a better assessment of any potential systemic risks that are affecting the sector than previously. Furthermore, we, as I've mentioned, we undertake an implementation assessment, which is an important complement to the other components of the holistic framework, to ensure that the supervisory and policy measures are actually implemented by national jurisdictions. And indeed, currently this year we're doing deep dives on jurisdictions that have major international insurance companies to see how they have implemented the supervisory requirements and policy measures, and we will be in a position to report later this year on our implementation assessment. Last but not least, later this year we will report to the Financial Stability Board on the outcome of our implementation of the entirety of the holistic framework. And it would be 3 years since its introduction, and the Financial Stability Board asked the IAS, have decided that they want to monitor implementation for 3 years before they decide whether to adopt fully the holistic framework as their method of assessing systemic risk in the insurance sector, and therefore abandon in its entirety the previous system we had, which is the global systemically important insurance framework. One of the key inputs to the report to the Financial Stability Board will be feedback from stakeholders on how you think that the holistic framework works. And this is the purpose of today's session. I will now hand over to Romain Pastron, Deputy Secretary General of the IAS, who has been leading from the Secretariat the work on the implementation of the holistic frame over the past 3 years, who will give some more details on what we have planned for today. Romain, the floor is yours.
Thank you very much, Vicky, and I hope that everyone can hear me as well as you. So, of course, a welcome from my side to everyone, to all the participants and the panelists for today's event. Actually, in our program, we will have 2 panels today, and I would like to say a few words about the content of these 2 panels. So the first panel will be moderated by Dieter Hendrichs, the chair of the IAS Macroprudential Committee. This panel will consider the first element of the holistic framework, the global monitoring exercise, as it was described by Vicky. And as you know, this global monitoring exercise relies on 2 sets of data collection, one from a pool of individual insurers and the other from our members. And the global monitoring exercise has been designed for monitoring key risks and trends and the potential buildup of systemic risk in insurance. So considering the nature of the risk of the global insurance sector and how they can rapidly evolve, as we have seen, we will discuss the pros and the cons of the approach set out in the holistic framework to assess this risk. And for this discussion, we will be joined by speakers from the Institute of International Finance and AM Best. Then we will move on to the second panel, which will be moderated by Peter Braumüller, the chair of the IAS Implementation and Assessment Committee. In this panel, we will discuss the policy measures reflected in the Holistic Framework Supervisory Material and their implementation in a globally consistent manner. We will notably consider the process that we have put in place to assess this implementation and the conclusions to date from this work. We will be joined on this session by speakers from the Global Federation of Insurance Associations and the Geneva Association. In both sessions today, we will start with a panel discussion, including senior representatives from internationally active insurance groups, and then we will open up to questions from the audience. So please use the chat function to send questions or raise your hand when we get to the relevant sections of today's proceedings. And with that, I will now hand over to Dieter Hendrichs, the chair of the IAS Macroprudential Committee.
Thank you very much, Romain, and I hope everyone can clearly hear me. So also big welcome from my side to this roundtable on the holistic framework. Now, as said by Romain, I will guide you through the first panel of today, which is dedicated to one of the key pillars of our holistic framework. Indeed, as a first key element of the holistic framework, the global monitoring exercise, or GME, as was already explained by Vicky, tries to assess the financial stability risks from an insurance perspective. The GME is designed to assess global insurance markets trends and developments, and in that sense also tries to detect the possible buildup of systemic risk in the global insurance sector. This includes, as Vicky already explained, an annual assessment by the IAS of potential systemic risk arising from sector-wide trends, but also possible concentration of systemic risk at the level of individual insurers. As such, for the GME, we collect data, and the GME builds on the data collected from around 60 of the largest insurance groups and 30 jurisdictions. And in total, by doing this, we cover over 90% of the global gross written premiums, which, if I can state, is a quite representative sample even on global level. The outcomes of the GME are reported every year to the FSB, but also to the public through the Global Insurance Market Report, or GMAR. We also make sure that insurers who have to participate to the GME get their individual feedback reports. Now, as some of you may remember, we have experienced a challenging start of the global monitoring exercise. So the first year, you may remember that in 2020, we used the global monitoring exercise to perform a targeted assessment, aiming at trying to assess the impact of COVID-19 on the global insurance sector. It was only last year, so in 2021, that we were able to perform a first full regular GME covering immediately 2 years of data, so end of 2020 data and end of 2019 data. Also this year, we will have a full global monitoring exercise. Now, in this session of the roundtable, I will try to gather your views on the best tools to monitor and manage the key financial stability risks from an insurance perspective. We will try also to zoom into the process that we use for the global monitoring exercise, and we'll try also to highlight the insights that the exercise provides for you as a stakeholder, for instance, through the participating insurance reports, or as I just mentioned, the GMAR, or Global Insurance Market Report. We will also try to discuss the pros and the cons of this more holistic approach that we try to apply here to monitor and address the financial stability risk, which combines, as Vicky already highlighted, a sector-wide and an individual insurer approach. And we will try to compare this approach with the approach that we have previously known and which focused on identifying and addressing risk solely at the level of the globally systemic important insurers, or GSIIs. Now, as a first step of this panel, and by way of introduction, I would like to ask initial feedback, initial input from the Institute of International Finance and from AM Best. So first of all, I will try to give the floor to Mary Frances Monroe, a Director of Insurance Regulation and Policy Regulatory Affairs at the Institute of International Finance. So please, Mary Frances, go ahead.
Thank you, Dieter. And thank you to the IAIS for convening this roundtable and for extending to the IIF an opportunity to speak today. As Vicky explained, the IAIS's holistic framework is multifaceted macroprudential supervisory framework that has the important goal of assessing and mitigating systemic risk in the insurance sector. Although the framework is multifaceted, I will focus my comments this morning on the GME, the Global Monitoring Exercise, which consists, as Dieter mentioned, of both the sector-wide and individual institution monitoring. We believe that the IAIS has used the GME very successfully to inform recent global insurance market report publications, notably on the impact of COVID-19 on the sector and on insurance sector climate risks, as well as the most recent exploration in 2021 of the sector-wide macroprudential themes of the low interest rate environment, the trend of private equity ownership of insurers, credit risk exposures, and cyber risk. We commend this ongoing work on risks or trends that may potentially have systemic implications. And we also commend the recent expansion of sector-wide monitoring to include the work that was previously conducted through the annual Global Reinsurance Market Survey. It is good to hear from Vicky about the extensive and meaningful collective discussions that have taken place, particularly last year, based on the information collected through the Global Monitoring Exercise, both on a sector-wide basis and from individual institutions. We believe that the primary, but not exclusive, but the primary focus should be on developing an understanding of sector-wide risks, as this is where the IAIS best adds value and avoids overlap with the work of group supervisors. The insurance sector level review should focus on reasonably likely impacts to the global markets and real economy via a clear transmission channel, consistent with the focus of systemic risk analysis, which is, as we all know, the risk of widespread disruption to the provision of financial services, which causes serious negative consequences for the real economy. We believe the analysis should take into consideration the range of risk mitigants that are available to limit the potential for these activities to give rise to systemic risk. For the individual institution monitoring, the focus should be at the group level, as I believe it is, and the review of individual insurance groups should be carefully coordinated by the group supervisor. Any prudential response to reasonably likely systemic risks at an individual insurance group needs to be carefully targeted and proportionate, addressed at the group level by the group supervisor, and employed only when existing supervisory tools are clearly inadequate. The potential for extraordinary supervisory tools to affect other activities or lines of business of the insurer should be carefully considered as well. We believe that qualitative analyses informed by targeted quantitative information are the most useful, as they avoid the false precision of overly quantitative analyses. And also, this reflects the fact that full information may not be available in current data, especially when one is looking at forward-looking risks and trends. We believe that scores and relative rankings can be helpful high-level inputs, but the collective discussion of key and emerging risks and trends is where the value add for supervisors occurs. The development of IAIS analyses has benefited greatly from coordination with the industry and with external stakeholders, and in particular of the CRO groups. We encourage this continued coordination. Jurisdictional coordination and capacity building are essential and are facilitated by the collective discussions of the GME results that take place at the IAIS. The IAIS regularly reports to the FSB in order to provide an insurance sector perspective to the FSB's cross-sectoral assessment of global financial stability. And we encourage further supervisory level coordination and collaboration with banking and other financial institution regulators and supervisors in order to help develop a financial system-wide view of risks and critical interlinkages. So thank you again for the opportunity to participate today and to provide some initial comments, and I look forward to the panel discussion.
Thank you very much, Mary Frances, for this input. And next, I would like to turn to Greg Carter, Managing Director of the EMEA and Asia Pacific region at AM Best. Please, Greg, go ahead.
Dieter, and thank you very much to the IAIS for this invitation. I must say I find it a little daunting to be speaking to so many regulators, particularly as some of those regulatory bodies are also the bodies that supervise credit rating agencies. So I need to be on my best behavior. And probably I need to start by pointing out that part of our regulatory remit or limitations mean that we have to be very careful not to be seen consulting or to be giving advice. So my involvement in the debate may be a little limited by some of those factors. And as I often say in both my professional and personal life, I don't do advice. So I'd like to start just by talking a little bit about the GMAR and comparing and contrasting that with some of the key risks that we see facing the insurance sector globally. And when I look at the GMAR and the three top items that Mary's already highlighted, I don't disagree that those are very important risks, very key risks for the sector as a whole. I don't necessarily have them in my top three, but they're definitely in my top 10. I think at the moment for us, probably top of the list would be inflation. And we've come from an environment where we've had ultra low interest rates, very low inflation, deflation in some territories for many years. And we've been really on, if you look at the charts, probably a sort of 40-year trend of declining interest rates. And we're now seeing a reversal of that, and quite a rapid reversal. And I think that shift really does present a very significant risk for companies to transition. And I'll perhaps come back to that with a specific example later on. There's also probably a handful of other risks that we see as absolutely key and driving for us, from our perspective, the credit quality of the industry. And I think one of the issues is not a specific risk, but it's what I just call a trend in risk, and that's the evolution of risk. And you can become familiar with a risk and get comfortable with it, but the challenge is staying on top of that risk as it evolves. And I think probably a good example of that would be just to take, say, the motor line of business. Motor is, in most markets, it's a mature, well-established line of business. It's a high-volume business, generally profitable, highly competitive, and with pretty high barriers to entry for most players. And you'd think that the risks of that business would be well understood. But what we've seen is the impact of technology, and particularly the use of data. And if you go back 10, 15 years, we saw the introduction of telematics. And telematics really changed the shape of how that risk was measured in terms of moving away from size of vehicle, age of driver, simple metrics like that, down to much more individualized data collection. And telematics really has changed the shape of the industry. I think I saw a statistic recently that suggested that around about 50 billion euros of motor business is driven by telematics data. So it's clearly a major change in the marketplace. And if you look forward, the much heralded driverless cars, then that would have an even more dramatic change on the risk of motor insurance. So that changing evolution of risk, the rapid evolution of risk, is something that we think is key to risk assessments. Another big area that we see, more specifically, is in terms of liability accumulations. So what I would describe as a casualty catastrophe. And I think when you look at what drives casualty catastrophes, it really is changes in things like the legal environment, technological changes, and also social environments. And those are things that can change fairly rapidly, and we believe could create an accumulation of liability risk. Thirdly on my list would be natural catastrophes. Obviously, we're well aware of some of the issues driving increased natural catastrophes. But I think we're facing potentially a perfect storm, to pardon the pun, when you look at the increased frequency and severity of windstorms, floods, and wildfires. You're also seeing at the same time an increased or a longer term trend of urbanization and concentration of populations in high risk territories, high risk locations. if you couple that with the inflationary pressures, then you can foresee a scenario where the accumulation of risk from natural catastrophes increases potentially exponentially. And finally, on my list, I would put supply chain complexity, and I think what we've seen through COVID has emphasised the risks, particularly around potential impact of business interruption. So those are some of the key risks that we would see that we would add to the top 3 on the GMAR. So with that, I'll pass back to Dieter.
Okay, thank you very much, Greg, on this risk perspective, and I think we'll be coming back to some of those items as well later on into the panel. Okay, let us move on to the open part of this panel. And for this part, I will ask a series of open questions, basically to everyone, but I will in particular invite a series of panelists to give us their initial feedback on these questions. And allow me to quickly introduce these panelists. So we have, as part of the panel today, we have Hugh Francis, Director of External Reporting Developments at Aviva. We have Yasushi Ueda, CRO of Meiji Yasuda Life. And we have Nick Silic, CRO of Prudential Financial. Welcome to all of you. And allow me to throw in a first question. And for that question, I will already try to link to some of the things Greg mentioned earlier. So in general, one of the questions, of course, we are facing in the global monitoring exercise is to figure out which are the best tools to monitor and manage the key risks for financial stability from an insurance sector perspective. And in particular, I'm interested also to know, to get your view on how best to set up these tools to make sure that on one hand, we are making sure that they are functioning quite well during times of crisis, as we've known during COVID-19, but also are trying to, or are being able to capture new and emerging risks. And this was some of the elements that were also mentioned by Greg earlier, how to make sure that if risks evolve, if trends evolve, that your risk assessment framework is able to keep up with the pace the risks are evolving. So I'd like to open the floor. If any one of the panelists would like to come in on this first question, just raise your hand or use the chat function. If anyone else from the public would like to come in, also please ask for the floor through the chat function, and we'll make sure that you get access to the panelist discussions.
So Dieter, I'm not quite sure how to raise my hand here on this. So
go ahead, please.
Can I jump in? Thanks for the opportunity to be here today. I think from a tools perspective, what you put in place in terms of the aggregation and the evaluation of the risks that we're taking do a very good job of understanding and assessing the risks that we have on the liability side. And I think that that's very useful. We can see where the industry is taking deep pools of risk on and evaluate what those risks are doing, presumably to the extent that they're evaluating physical risks. We can examine where the concentrations are and whether or not that becomes systemic. So I think that the tools work really well from that regard. And then on the asset side, understanding, and the liquidity side, understanding how the specific positions of each of the individual companies are working does a very good job as well. I think the place that we're missing is that aggregation of that data, the place that we're missing is understanding what the evolution of the global financial markets and the impact that might have on the insurance groups broadly. And for that, I say that ecosystem is much broader on the financial side. So the ecosystem it's insurers, it's banks, and it's the shadow banking system, which I'll broadly describe as structured credit and private credit. And I think that a lot of the systemic risk that we've had, at least stemming from the asset side, comes from breakages in that ecosystem. So you have, for instance, Basel I put charges out such that mortgages were very, very expensive to hold for banks. So basically, within a matter of years, all of the mortgage exposure flowed off of the banks, the mature mortgage exposure anyway, flowed off of banks' balance sheets into CMBS. That may or may not have been a good thing for this financial stability of the overall system, but we should be aware of that. Similarly, anytime there's big movements, whether it's movements into structured credit or into private assets and away from the regulated entities, evaluation should be done. So I think that's one of the things, an evaluation on that macroprudential world of the external forces that can come and impact the insurers on the asset side. I think on the liability side, we do a terrific job. And one thing I'd say is stress testing for us is the tool that we use. That's harder to do on at a global level for the macroprudential IAS type supervision, but the stress testing we feel is probably the most targeted tool for searching out risk to a common thread across broad insurance groups.
Okay, thank you very much, Nick. And I noted down indeed the importance of stress testing as a tool, which I think we're trying to, from a top-down perspective at least, make developments as well at IAS level. And I also noted down your interesting remark on how to make sure or how to integrate as well this cross-sectoral perspective, how things move along in other financial sectors, how this may impact the insurance sector and vice versa. Indeed, that's a very good point. And sometimes by looking mainly at the insurance sector, we should be wary not to forget some of these interactions with some of the other financial sectors. Indeed, thank you very much for highlighting that. Now, if I can maybe emphasize also the second part of my question, and if anyone would like to jump in, please do. I would also be particularly interested to get your view on how to deal with a risk assessment framework and I think I come back to the point of Greg, in an environment that is quickly evolving. So you may remember that during COVID-19, we've issued this very targeted data collection, trying to capture how COVID-19 impacted the insurance sector. At the same site, and 1 year later, we also had to introduce the more global monitoring exercise consisting of a whole series of data elements. So the fact that we have to bring together these two aspects, having a more general framework for risk assessment together with a framework that is flexible enough to react to an ever-evolving environment, is something which is, I think, not only for supervisors, but probably also for insurers, can be quite challenging. So any views on that I would appreciate very much. I see Hugh has asked for the floor, so please, Hugh, go ahead.
Yeah, I'm happy to pick up both of those points, because I think it affected this. I think at both the global supervisor for individual companies is a function of what is good risk management. So it's a combination of horizon scanning. It's a combination of understanding the risk you're exposed to. I hasten to that because I think on the systemic element, I think for the insurance sector, it's far more about the risk we're exposed to than those that we generate. But, you know, it's that plus that, as Nick says, that combination of having your own data and also having that ability to stress that in the context of forward looking. I mean, I think that we do that individually as companies. We see that, you know, individually we're going through our emerging risk process now. We see, you know, for like the CRO forum, or, you know, will be release annually their emerging risks. So there's that element of forward lookingness, and then there's that element of being able to respond at the point that something happens, which is, I think, a combination, which is where I think the GMM work well, is that combination of having a latent supply of data, which is how a company would have it, in which they can assess their exposure, their asset valuation, their liability changes, plus when needed, a specific request or input for information on the points which are the hot topics. I mean, my personal view is I think that worked very well through the COVID crisis, because individual companies were doing the same. We were having like a management committee that met regularly as a risk team to assess these. You focus on your extant data, which was having, you know, parallel for the GMM will be the annual data. And then you have that focus as targeted data. What am I particularly interested in? What am I looking at my claims frequency in this area? How am I responding to that? How are my assets working? So to my mind, I think that really the most effective way of looking at it is the parallels between how we as individual companies seek to manage those macro risks that we're subject to, and how actually that aggregates, as Nick says, into how we cross that across the sector, which is a combination of qualitative as well as quantitative. I wouldn't ever underestimate the importance of that qualitative assessment. And I think one of the important elements has been the flexibility of the ongoing interactions that we have had with individual supervisors and IAS to discuss the risks between us. So I think it's that flexibility plus having that bedrock of information in the first place that provides the starting point for the discussions.
No, thank you very much, Nick, and thank you also again for flagging this importance of combining quantitative and qualitative info. I think it was Mary Frances who highlighted this as well. There is only so much you could collect with quantitative data, and qualitative input does allow us as well to get some more forward-looking perspective on certain elements, which you could also get through a quantitative stress testing, but at least the qualitative input next to gathering quantitative data is indeed key to as part of the risk assessment framework that we are striving to set up here. Allow me to move to a next question. I see that the time is passing by quite quickly. We've mentioned already a few risks, and I think it was Greg who highlighted a few of those risks we are currently experiencing. My question for you would be, what is the nature of the risks which are most likely to be systemic from an insurance sector perspective? And would that then either be or expecting to be the insurance sector as the source of that risk, or rather as one element or a transmitter of the risk that may be originating somewhere else, and as such potentially creating spillover effects from the insurance sector to the rest of the financial system, or vice versa? And linked to that question, and in line with the philosophy, I would say, of the holistic framework, would you expect these risks to be concentrated rather with individual insurance group, or should we rather try to monitor activities and exposures, or a combination of both? So that's a very open question on the nature of potential systemic risk and the link of that of those risks with the insurance sector. If anyone would like to jump in, please feel free to ask for the floor.
So Dieter, I might jump in at the beginning there. So the types of risks that we think of as systemic, I think on the liability side, I don't know if there's anything systemic that jumps to mind at this point. I think that the industry does a very good job of diversifying its exposures on that front, you know, not that we haven't made mistakes in the past broadly as an industry, but I think that we've been very focused on that collectively, and certainly our supervisors have been collectively focused on that. And if you think about it, one of those places where the reinsurance got us, where the insurance activities got us into trouble, was when we were insuring capital markets instruments. So at the end of the day, the connective tissue wasn't even in that case in 2008. The connective tissue had more to do with had more to do with the asset markets and the bubbles that were there and the dislocations that were there than it did. I mean, it ultimately manifested in certain insurers suffering, but and created systemic risk because of the feeling of safety in the asset markets when it wasn't really there. So that interconnection is important, but I do think broadly on the insurance side, we do a pretty good job, notwithstanding, I think, Greg's points about as those risks evolve, whether it's COVID or whether it's in the auto business. I think in the auto business, for instance, if everybody's on a self-driving car, honestly, your cyber insurance, your cyber risk goes up dramatically because one person can cause an awful lot of damage to a whole bunch of cars real fast. So I agree with that point, and we should stay focused on those emerging things around the edges. On the asset side, I think the risks there's been tremendous dislocations in that market. And like I said, that ecosystem between insurers, regulated institutions, insurers and banks, and unregulated worlds such as the shadow banking system, and like I said, private credit and structured credit. And I think that if I were looking for systemic risks, I would look at risks that have flowed out of one and into others, and how is that happening, and which asset classes are building quickly and not. And at a time when I think the asset markets, I think broadly, certainly if we do head into a global recession, which is looking increasingly likely, I think that there will be real pressure on credit markets such that we haven't seen in perhaps since the late 80s, early 90s. And if that were to happen, you will see defaults and certainly lower graded assets falling quickly. And in that regard, I think understanding where the true risks of that now lie, and it's not as straightforward as it used to be, where it was all on banks' balance sheets. The insurance companies had the large investment grade bonds, the banks had the smaller bonds. Now those risks have been securitized and are owned broadly across the groups, and understanding how those flows work and where that risk ultimately resides, I think will become the next structural component broadly for systemic risk.
Okay, thank you very much, Nick, and thank you also for describing also a little bit the difference between the liability and the asset side of the insurer, which indeed in terms of systemic risk have a different nature. It's also, I think, within the nature of the insurer to try also to bring those together and the better you do that, the better your ALM management, the better you withstand risk in general, I would say, as an insurer. Anyone else who would like to jump in here?
Yes, please, Dieter. Actually,
yes, please, Greg.
Just to pick up on one point that Nicholas made, I don't disagree with your comments generally about liability, but I think you could take the view that actually we had a near miss in terms of business interruption, and I think COVID proved that if courts had taken a different view on policy wordings, we could be in a very different scenario. I think, given the magnitude of potential losses, if you try to boil it down to some kind of binary decision, your choice is wipe out the insurance industry or go the route that we've gone. So I think it was almost too big a problem for the insurance industry to face. But I do think that does qualify as a little bit of a near miss. And I think if you contrast that with sort of how trade credit went through that process, and the ability of trade credit insurers to reprice business and to manage risks, and also the way that governments reacted, then I think we saw a very different outcome, or we would have seen a very different outcome in that scenario. So I didn't want to disagree with you, Nicholas, but I thought.
No, I think that's a very fair point, though.
No, it's a fair point indeed, and I think it highlights also the importance of policy wording, and it's also a topic which comes up from time to time when we discuss, for instance, on cyber risk and the importance of policy wording in that field, and how that could also generate risks with a potential systemic nature. Now, allow me to jump back again to the second part of my question, because a part of the holistic framework is actually IIS trying to achieve a combination of looking at individual insurers, but also looking exactly at which activities and exposures could potentially generate systemic risk, or at least have trends that are worthwhile following. And this is, of course, different from the previous system, where we focused on a limited set of globally systemically important insurers, or GSIIs, as we refer to them. And also with a set of policy managers only linked to those GSIIs. Whereas now, I think, and it was already highlighted by Vicky, when we have a collective discussion, we have a collective discussion on all different aspects and all possible supervisory responses that could go beyond focusing on just individual insurers. And I would also appreciate your view on that. How do you feel about the fact that the framework has evolved from a focus on individual insurers towards a focus on activities, exposures, and the link to that, the supervisory response. Do you see any strengths in that framework, or do you potentially could also highlight maybe some weaknesses of that framework? So anyone who would like to jump in? I see you asked for the floor, but it was maybe on the previous question. But if you want to give your input on this one, you're very welcome, of course.
Yeah, as a previous member of what we used to call the club no one wanted to be a member of, i.e. the G-side, I mean, we very much welcome that change of direction, because I think one of the things we always struggled with was that basically there was such a gap between, if you look at the GSIB list and the GSI in terms of interconnectedness and where you have really impact, that from our perspective, there was little logic of that individual identification, because we work in largely diversified markets very clearly across jurisdictions that differ quite a lot by nature. And so we were really struggling to understand how we would give rise to systemic risk through one of our individual failures in the definition that was given by the FSB potentially. So therefore, I think that shift to more holistically look at a wider group of risks that we as a sector would have, we were very much welcome, because I think we see that, you know, we just struggle to see how an individual a company would cause a spillover failure across because of the nature of our business. Now, in that respect, I think that the important element is to really look at those type of risks that it's really when we're all subject to the same risk together. As I say, I'd reiterate that I think we probably would still say, even if we look at collectively as a sector, it is less about what we as a sector will do en masse. It's more the macro risk that we're faced to, and whether we do something together, which happens all at the same time. So whether that's on the investment side, or whether, you know, if you look at something like the geopolitical risks, or even on climate, you know, it's more about how we coordinate our action between us. So I think to that extent, we very much welcome that move to what we as a sector are doing about, because I think we struggle to see how an individual action is going to lead to a knock-on impact. I mean, if you talk about our sector giving rise to systemic risk, you know, it would have to be a collective action when we're all impacted in the same way and we take the same action. I mean, I struggle to find some, but, you know, I think that as a concept is one that is far more relevant to us. I think in reality, what we tend to find is, whether it's even the credit crunch that Nick was alluding to, or kind of like the knock-on impact of the geopolitical stability going on to economic impact, including inflation and stagflation that Greg referred to. I think it's more about how that impacts us, and therefore then that feeds through to our pricing and how ultimately product availability. But that is kind of like a sectoral issue. It's not an individual company action. And I think that is a far more logical way in which to look at both the systemic risk we could give rise to and the impact of macro risks on us as a sector.
No, thank you. Thank you for that input. And I think it highlights perfectly also the nuance that we try to achieve when talking about inward risks, so the risk that the insurance sector is exposed to, and the outward risk, so the risk that potentially could spill over from the insurance sector to the rest of the financial world and ultimately the real economy. And it's indeed this nuance that we also try to bring as one of the key aspects of the holistic framework. And as you say, at least by looking at activities, by looking at exposures, we hope, of course, to capture the broader aspects of systemic risk, which you might miss out, I believe, if you only look at individual insurer. Thanks for that. Anyone else who would like to jump in on this particular aspect of the holistic framework and the global monitoring exercise?
I would just support what Hugh said. Honestly, the issue that the systemic outcomes derive from activities as opposed to companies, I couldn't be more in alignment with. The activities, the connective tissue to all of that, as Hugh said, is either on the liability or the asset side. If we interact and are exposed either to external forces coming to us, which would largely be through the asset side, or on the liability side, if we are pushing systemic risk out into the world because they come to rely on a certain degree of coverage and safety that disappears as a result of some sort of a blanket outcome. So I do think the activities based approach. And I think the way that you're aggregating the data and collecting it makes a lot of sense at this point, along with the idea that perhaps as certain specific elements take place, you can do like we did during COVID, where you put out the phone calls and all of us were doing it anyway. So it was very little effort to share it with our supervisors. And then possibly stress testing on certain elements. If you start getting, if they're on that macroprudential world, you identify things that might be of concern.
Okay, thank you very much, Nick. Anyone else who would like to jump in here? Yes, I see a hand up from Yasushi, please.
Thank you. The past consultation document about the holistic framework prescribed that the assessment of systemic risk is likely to be time varying, depending on the economic environment, the financial infrastructure, and crisis management arrangements. In other words, the nature of potential systemic risks can be variable over time. That means there can be various views. Therefore, I think it's not easy to prescribe the nature of systemic risk. Having said that, personally, liquidity risk would be the most important as a potential cause of systemic risk in the insurance sector. Specifically, a lot of insurers may operate in the same markets, or they may be active in the same financial instruments. Given that situation, if something happens in economic circumstances, these insurers may take the same actions at the same time. This kind of collective action may cause significant disruption to the wider financial system by the risk transmission across firms as a result. In my view, it's important to pay attention to the possibility of systemic risk stemming from collective actions as a matter of first priority. In that sense, we understand the necessity of the development of the liquidity metrics as ancillary indicator, the context of the IIM. On the other hand, if insurers don't match liquid liabilities with sufficient liquid assets, it might have liquidity risks. However, if insurers hold sufficient liquid assets, it would not be a source of systemic risk. Therefore, it should be evaluated, taking into consideration the liquidity of the asset side and cash flow from level premiums that insurers periodically receive under insurance contracts. From this viewpoint, we originally thought that liquidity coverage ratio developed by the BCBS would merit consideration. We generally support the development of liquidity metrics by the IAIS because under the draft design, the assessment of liquidity risk is based not only the liquidity of liabilities, but also that of assets and cash inflow from level premiums. We appreciate your acceptance of our view. However, we are concerned that a part of the draft design is directly copied from the banking regulation. In our view, the liquidity metrics shouldn't be overly conservative by carefully considering the nature of insurers' liquidity risk and the characteristics of their business. In order to assess liquidity risk of the entire insurance sector appropriately, it's important to evaluate liquidity risk of individual insurers based on circumstances of each jurisdiction and economic reality of each insurer. That is my view to the question. Thank you.
Thank you very much, Yasushi. And yeah, I think it highlights again, indeed, the importance of monitoring also this liquidity aspect. And as you say, it's very much a metric which is evolving. We hope to have some more final view near the end of this year. And as you highlight, it's also work in progress. I think it's more commonly known and investigated at the level of banks, but we try to capture through the liquidity metrics, also the liquidity aspects at the insurance sector side. And I think it's indeed another example of a risk that is worthwhile monitoring, not only at individual level, but also at sector-wide level. Thank you very much for that input. Allow me to move maybe to the last question for this panel in the interest of time. I think we sense at least that an approach which tries to combine the activity-based, exposure-based approach with an individual approach is for many reasons an avenue worthwhile pursuing. Now, it's not a free lunch, because those of you who have participated in the global monitoring exercise, they know there is a whole process behind it. They know that data, for instance, is collected, because without data, even if it's qualitative or quantitative input, it's difficult for us at the level of IAS to perform such a global monitoring analysis. On the other side, we also try to provide the output of our discussion to the stakeholders, be it either through the participating insurer report, so which is the report which you receive if you participate in the individual insurer monitoring part of the global monitoring exercise, but also to the broader public through the Global Insurance Market Report, GMAR. I would very much appreciate your views also on this process part of the global monitoring exercise. How do you feel that is going? Do you see any strengths, weaknesses, and how do you feel about what we give back to the public in terms of output of the IAS discussions? So if anyone has any input, or please feel free to ask for the floor.
Yes, I'm happy to start from a sort of neutral perspective, because obviously we don't take part in the exercise from our own perspective, but obviously we do see the output ultimately. I think one of the challenges with an exercise like that is by the time you've collected the information, aggregated it, and summarized it, risks emerge rapidly. You get caught out a little bit, and I think the Ukraine situation and the knock-on effects and the exacerbation that's had on supply chains, on inflation, is an example of that. That said, I don't want to belittle the effort and the value of the output at all. The only other thing I would sort of say on this subject is whether, this is perhaps one for people to comment on as well, is if we thinking about future monitoring exercises and collection of data, and thinking about IFRS 17, does that actually present an opportunity for greater harmonization of collecting that data and regulatory reporting more generally? And that's just something that comes to mind when you ask that question. I don't have an answer. It's obviously one more for the regulatory bodies to consider. But I thought might be helpful if I start from a neutral's perspective, and then the participants can comment.
Thank you very much for that, Greg. And I think you highlighted the two main challenges of such an exercise. That's first of all, how to be still relevant by the time that you report. And I mean, I can tell you this year, the high inflation, low growth environment is very much on our agenda, but it's true that at the time that the previous GMAR was published, this was a new trend coming up. And by the time that we will publish again this year our report, let's see if it's still there, although I'm afraid that inflation is here, the high inflation is here to stay for a while. And the other element is indeed, you also pinpoint to the fact that we do not have a harmonized global framework for data collection at the insurance level. Even also, we know our colleagues are doing efforts to develop an ICS, for instance. There is also no harmonized capital framework, which of course makes aggregating data challenging. I have no view immediately of whether IFRS 17 will help us with that or not. That's something we will experience in the near future, I will guess. But it's indeed two of the main challenges that you highlight, which we are well aware of indeed. Now you wanted to come in as well, please.
Yeah, let me pick up the process and the outcome side. I mean, I mean, practically on the process, this is on our third year going through that. I mean, we think that that process works well in practice. That ability to have that engagement with you beforehand, plus, you know, when we submitted, to be able to answer questions on that to clarify that. So I think the process at a national jurisdictional level really works well. I think the other advantages of it is it has proved flexible. And I know it's difficult to respond quickly, but the fact that, you know, you could get supervisory insights targeted on areas like cyber, on areas like COVID at relatively short timescales in the collation of trying to do data is really helpful. So those targeted requests, and the fact those targeted requests are both qualitative and quantitative, allows us to put a bit more flesh on the bone, so you're not left on that. And I think we also appreciate that dialogue at the national level with the local supervisors and the ability. So I think that leads to an outcome from our perspective that gives you a robust basis to have some sensible dialogue and discussion. I think it's also helpful from our perspective. There's both the IMM element and also the SWM, you know, the supervisory element, that overlay of those that understand your business and the specificities at the point that you're discussing it on a global basis, I think is really helpful, because I think what it means is that, you know, I think we've got many common goals on this as well, but that oversight of how you're looking at things from supervisors and your experience combined with how we're looking at companies, I think is one of the strengths of this, particularly to the extent that, you know, you get commonality of views arising on that. I think we often have the same views on many of those things. And I think the other thing is that, you know, there are challenges. I mean, the reality is there isn't going to be a global IFRS because not everybody's going to do IFRS, you know, so there's not going to be a global accounting standard. But, you know, I think the more that there's dialogue between, the more the differences in understanding of the common language develops. So it's not going to be perfect, it's not all, but the fact that we're now hoping that data, and I probably would compare, the most important thing from my perspective is the outcome that generates. It just meant that as a sector on the global stage, in discussion with both the FSB, IMF and others, and the banks and the central bankers, if you compare to where we were last year when we hit and we had COVID and we had issues, compared we were 5 years ago, we have just had a kind of like a step change in our ability to give confidence that we're monitoring these in a way that we didn't before. And I think that's as important as anything, is that there's a robust process that we understand that is flexible and that we can flex in a way to basically look at those risks that we're subject to collectively. And I think that's the real strength of it, is if I contrast to when we came out of 2008 and when we came into 2020, our ability to know where we stand and what the issues are, and then dialogue further on that, was at a different level than we were 10 years ago.
No, thank you. And sorry, Nick, please go ahead.
I couldn't agree more with that assessment. Foundationally, the aggregation of data is always tricky, but it gets easier every time you do it. I witnessed when we started comprehensively stress testing our company, 8 or 9 years ago. It was at first very difficult, and every year it gets easier and easier to do because the DNA of the company changes to make that happen. And the same thing, reporting the collection requirements, the data requirements, the first time are hard to overcome. But over time, that becomes part of the DNA of all of us and how we react. I also think that the fact that the GMAR is not always timely is not the big issue here, because the infrastructure that you put in place to develop and the dialogue that you have with all of the companies in that ecosystem allow you to lean on that when you need to get to faster outcomes. So whether it was COVID or whether it is inflation, you can have spot checks that go in and you can give, and the decisions that for many of these systemic pieces, a lot of the times the IIS will be making decisions on what actions should be long before the GMAR is prepared around these rapidly evolving risks that are coming to the forefront and creating systemic outcomes. So I think the framework basically is a really good start to the development of this ongoing development, and we'll see where we go. But you don't get to Paris from New York without at least taking a step into the Atlantic Ocean, right? And so I think we're well on our way there, and I think we may change direction a bit down the road and find ways to enhance it. But I think it's a good start.
Thank you very much, Nick, and thank you as well. I think I couldn't agree more. I think the parts of the elements that you highlighted are also the parts that we perceive as strengths. The dialogue, also the regular dialogue at CRO level, at participant level, also at individual level on for those who have discussions with their national supervisor. The flexibility of the framework, which allowed us in fact to cope with the COVID-19 pandemic early on into the crisis and adapt the GME to that crisis. Which is, I think, a key strength of a framework if you're able to be that flexible when needed. And also thanks, Nick, for giving us hope, at least, that aggregating data gets easier every year. I think that's something that the colleagues will appreciate very much. Thank you very much. I see we have some 5 minutes left on this panel. So I would very much like to see if there's anyone in the broader audience that would like to ask a question either to myself or to one of my fellow panelists. So I would very much like to open the floor more broadly. Feel free to ask for the floor through the chat function, and we'll make sure that you get panelist access so that you can take the floor. Is there anyone with a question or maybe a comment or a remark on the global monitoring exercise in general? Yes, I see that Steve Shimshak has asked for the floor. Can we give him access to the panelist?
Hi, good morning or good evening or afternoon to everybody. Thanks so much for allowing me to take the floor. This is Steve Simchak from the American Property Casualty Insurance Association. This has been a very interesting conversation, so thank you. I guess my question would be, has the IAIS received any, or the folks on the call from the companies, have you received any feedback from the FSB so far in terms of what they think, and not even it's not exclusively to whether the FSB will accept the holistic framework going forward, but I mean, has the FSB taken any lessons from the holistic framework? Are other sectors learning from the holistic framework? I just recall that in years past, one of our concerns has been that the insurance industry was having bank-centric approaches imposed on us, which is to say that we were taking too many lessons from the approach to supervising banks. I wonder, has anything changed? Has it gone the other way? Or are the banks now learning from us? Or is it, or are we still pretty siloed or a one-way street in terms of the learning? Thanks very much.
Thank you very much. And I think, to be honest, it's more for a question for FSB than for myself. I think one of the key elements of today is, in fact, because we have FSB colleagues here online as well, to make sure that they hear about ourselves as IAIS, but also as yourselves as participating stakeholders on the framework in general, which, as highlighted before, consists of different elements, and the global monitoring exercise is one of them. Whether or not some of the aspects that we've introduced in the systemic risk assessment at IAIS level, where we indeed try to combine the individual insurance approach with a more activity exposure-based approach, will be also applied for other sectors. I'm afraid I cannot give you that answer. At least the experience from an IAIS perspective is that, I think it was highlighted by several of our panelists, that by combining both, you do add an extra layer to the systemic risk assessment, which gives you a much more broader view. With the additional challenge, as Nick highlighted, is that you can try to better understand some of the interactions of the insurance sector with the other financial sectors. I think that's one of also the key challenges where we could still further develop to the near future. I don't know if anyone else wants to jump in on that. But we'll make sure to come back to you once we get a more specific view also from our FSB colleagues on all these aspects. And I think near the end of this year we'll get a clear view on the future of the holistic framework. Anyone else from the public with a question? Maybe one last one before we move on to the second panel of today. If there are none, okay. Well, then, first of all, I would like to thank my fellow panelists and the introductory speakers for their contributions today. I hope that you found it an interesting and useful panel, also the broader audience. And having said that, I think we've highlighted some of the strengths and weaknesses of the global monitoring exercise. I've heard a lot of strengths. I also heard some caveats, some areas where we could try to further improve, of course. And without any further delay, I would like to pass the floor now to Peter Braumüller, the chair of the Implementation and Assessment Committee of IAS, who will try to guide us through the second panel of today. So, Peter, please go ahead.
Thank you very much, Dieter. I hope you can hear me well. Good morning, good afternoon, good evening. It's a pleasure for me to moderate the second panel of today's roundtable. And the first panel, as you have just seen, considered the benefits of one of the elements of the holistic framework. But the holistic framework, of course, is much more than just the assessment of the risk in the global sector. So in this panel, we plan to consider the other two elements of the framework, which is on the one hand, the supervisory material, which sets out the necessary requirements for the respective policy measures, and the assessment of the consistent implementation of these standards and measures, which is of course important. On the enhanced set of supervisory measures for macroprudential purposes, this set expectations for enhanced macroprudential supervision and crisis management, supervisory powers of intervention that enable a prompt and appropriate response where a potential systemic risk is detected, and ongoing supervisory requirements applied to insurers. So over the past 3 years, we have further complemented the holistic framework standards with supporting material. And we published particularly application papers on resolution powers and planning, on macroprudential supervision, on liquidity risk management and recovery planning. On the second part, the assessment of the consistent implementation of the enhanced supervisory policy measures across jurisdictions. Last year, we published the outcomes of what we called the baseline assessment that indicated that our members have made quite good progress so far in implementing the holistic framework supervisory material. And we are now in the process of finalizing the more intensive, what we call targeted jurisdictional assessments of implementation in 10 major insurance markets. These are kind of deep dive assessments of the extent to which jurisdictions observe the requirements reflected in the agreed holistic framework related standards. So I think both these elements are important. On the one hand, these supervisory measures and policy measures, as we call them. On the other hand, now also this, so to speak, the final part on looking whether there is proper implementation of all of that material and application of these holistic framework standards in all relevant jurisdictions. So we try to cover in this session both these elements, and we will seek insurers' views, and the setup will be similar to the one of the previous panel. So first of all, we have asked two initial inputs from, on the one hand, the Global Federation of Insurance Associations. There will be Nicolas Jeanmat, the chair of the GIFIA Systemic Risk Working Group, and secondly, from the Geneva Association, and that will be Dennis Nordhoek, the Director of Public Policy and Regulation. Without any further delay, may I hand over to Nicolas?
Yes, thank you very much, Peter. Good morning, good afternoon, and good evening, everyone. And first of all, I'd like to thank the IS for the opportunity to share some thoughts on the identification and management of systemic risk in the insurance sector today, from the perspective of the Global Federation of Insurance Associations. So, obviously, the work of the IS on systemic risk is very important for the global insurance industry, and GFIA has continually engaged with the IS on this work stream, supports continued stakeholder engagement, and therefore we are very grateful for the opportunity to take part in today's discussion. So the topic is managing and responding to potential systemic risk in the insurance sector. But before we go into detail on the holistic framework or on how best to measure, identify, or monitor systemic risk, I'd like to first reflect on the issues that we are attempting to address through all this work. And some of the remarks I will make now have been touched on by the previous panel. But I would say it's good to see that there is quite a significant element of agreement between all stakeholders on many of these topics. And especially GFIA has always argued and continues to believe that conventional insurance is not systemically risky, and that systemic risk can only originate from a very limited number of activities undertaken on a large scale and in the wrong conditions. And this is in contrast to other areas of the financial sector, but such as in particular banking. And therefore, while GFIA recognizes the benefits of monitoring for systemic risk in the insurance sector, the monitoring framework should be proportionate and should reflect the specificities of the insurance industry. In this respect, GFIA fully supported the FSB's decision to suspend GSI identification as from the beginning of 2020. And furthermore, we support the discontinuance of the GSI's designation on a permanent basis. Indeed, the IS initial approach to identify and apply additional policy measures to a limited number of GSIs was not fit for purpose for mainly two reasons. The first one, as I just mentioned, and as has been mentioned by other speakers before, insurers are not intrinsically systemic, or insurance is not systemically intrinsic as an activity. Fundamentally, because in insurance there is very limited mismatch between assets and liabilities, very limited interconnectedness, and very low risk of overrun. And so identifying a list of insurers that would be labeled as systemically important is wrong, as it mirrors the approach taken in banking following the banking crisis, without due consideration for the significant differences between banking and insurance. I'm aware that this has been repeated many times, but I just wanted to make that point again today in this introduction. And the second reason why the initial approach was not the right one is that requiring higher capital for systemic activities is a flawed approach, even if it was found that an insurer could be systemic due to its activities, because adding capital in itself would not prevent real cases of systemic failure. So in contrast, GFIA has long supported a risk-related activities-based approach as an appropriate means for identifying potential systemic risks in the insurance sector. And as such, the global industry supports the holistic framework to enable macroprudential supervision that looks at not only the size, but also the activities that can have systemic implications. The holistic framework includes a number of enhancements to microprudential measures to mitigate certain risk exposures and to increase the resilience of the insurance sector and or decrease the probability and magnitude of a negative systemic impact where risk does materialize. The global monitoring exercise, GME, which has been extensively referred to in the first panel, in particular, we see it also, as of the speakers, as a useful tool, as it builds on a huge amount of quality data. It does not trigger any supervisory action, but helps facilitating communication between supervisors and insurers, which is key in developing a better understanding of risks and emerging risk management practices. Our members also report that the implementation of the holistic framework is progressing well. And this is in fact consistent with the IS baseline assessment, which showed, and I quote, a high level of observance and indicates that the 26 participating jurisdictions have made good progress with the implementation of the relevant standards of the holistic framework. And as a result, we look forward to seeing the input of the IS work on targeted jurisdictional assessments. What is important is the proportionate application of the holistic framework. As I just mentioned, the GME is a useful tool because it builds on massive amount of quality data. However, there needs to be a cost-benefit analysis of any additional or supplementary data requests. Insurers have been seeing increasing reporting burden year on year, and many are dealing with individual insurer monitoring, data collection, and ICS monitoring at the same time. The industry understands the need to include new data points, but would stress that any information request by supervisors is carefully considered and proven to be essential for fulfilling their supervisory duties. These will help avoiding unnecessary cost on both the insurers and supervisors. Finally, I would like to note that GFIA supports the development of liquidity metrics for macroprudential monitoring. However, these must be proportionate to the overall liquidity risk inherent in the insurance sector. Standardized liquidity metrics cannot and should not aim to cater for the full range of business models, liquidity risk profiles, and product and asset mixes in the global insurance market. Using multiple metrics is also likely to be of limited value and will only serve to create unnecessary burden for insurers without commensurate benefit. So let me wrap up quickly. I would stress that the global industry is overall satisfied with the current supervisory approaches being taken to macroprudential supervision and the implementation of the holistic framework. As I said, designating and applying additional policy measures to a limited number of G-SIIs is the wrong approach for our industry, and we support the permanent suspension of the G-SIIs designation. The holistic framework, in our opinion, has proven its worth, and from the industry's perspective, there is no need for further macroprudential reforms at a global level. What is important is the implementation of the holistic framework. What is important in the implementation of the holistic framework is the application of proportionality based on the size and complexity of the group. And with these, I would like to conclude my introductory remarks. Many thanks for the opportunity again.
Thank you very much, Nicolas. And we'll immediately hand over to the second initial input we get, that is Dennis. Dennis, you have the floor.
Thank you, Peter, and thank you to the IIS for inviting the Geneva Association to speak at this important roundtable and for allowing me to set the scene for this panel. I will focus my remarks on the benefits of the holistic framework versus the GSII approach, which is a pure entities-based approach, as we all know. At the risk of repeating what has been said by others, and not least echoing all the good points that Nicolas made, I would like to go back a few years, and to be precise, to 2010, just shortly after the 2008 global financial crisis unfolded. At a time, the global regulatory community, under the purview of the FSB, started their efforts to develop regulations for so-called systemically relevant institutions. And this was the time the term systemic risk was coined, and several institutions, including the FSB, BIS, and the IMF, were defining what systemic risk is. The FSB considered the following criteria to assess the systemic risk by an institution: size, interconnectedness, and substitutability. Importantly, the IIS added the time dimension, the speed of loss transmission to third parties, as an additional criterion. And this is relevant to insurance, as insurance liabilities, unlike banking obligations, do not immediately generate cash outflows. This is not to challenge the criteria for systemic risk, but what it shows is that systemic risk accrues not to firms, but to specific activities of firms. In March 2010, the Geneva Association launched a report called Systemic Risk in Insurance, an analysis of insurance and financial stability. The report pointed to the broad consensus that the insurance business model has specific features that make it a source of stability in the system. Insurance is funded by upfront premiums, giving insurers strong operating cash flow without requiring wholesale funding. Insurance policies are generally long-term, with controlled outflows, enabling insurers to act as stabilizers to the financial system. Based on the systemic risk criteria of the FSB, the report concluded that the main activities of insurers and reinsurers do not pose a systemic risk. In light of this, the report recommended for regulators to avoid placing special emphasis on specific institutions, as such an approach could distort the insurance market and, among others, draw supervisors' attention away from risky activities elsewhere. Our chairman at the time concluded his foreword of this publication with the following words: it is clear that the debate on systemic risk will not end with the publication of this report. Today, 12 years later, we are indeed still discussing systemic risk. And a lot of things happened after that publication, including the identification of the first cohort of GSIIs in 2013, a designation that was very much based on size. In the same year, we also saw the publication of GSI policy measures and the publication of an IAS report on macro-prudential policy and surveillance in insurance. And thankfully, in February 2017, the IAIS announced a work plan to develop a holistic framework for assessing and mitigating systemic risk in the insurance sector at a global level. This work consisted of 3 work streams, including the development of an activities-based approach to mitigate systemic risk in insurance, address cross-sectoral aspects in systemic risk assessment, and a revision of the entities-based approach. And as we all know, 3 years ago, the FSB decided to suspend the identification of GSIIs. Now, fast forward to July 2022. Although we are still talking about systemic risk today, the discussion has evolved in a positive way. The holistic framework has been implemented 3 years ago, and we are a few months ahead of a final decision by the FSB on whether to permanently discontinue the GSI designation, and leaving us with the question whether the holistic framework is indeed fit for purpose. Let me start out by saying that the Geneva Association very much supports an activities-based approach to systemic risk. Over the past 3 years, the holistic framework underwent real-life tests in crisis situations, starting with the COVID-19 crisis and now a major geopolitical crisis. Over the past crisis years, the insurance industry has proven to be resilient, and it is fair to say that the holistic framework has provided supervisors with a powerful tool to monitor and assess emerging systemic risks within the insurance industry. An interesting question would be to what extent a focus on GSIIs with separate, more intensive standards would have gotten us to a better place in terms of financial stability monitoring. The answer to this thought experiment would likely be no. Under the GSII, the focus would be on the largest companies, which, depending on the scenario, may not be where the risks reside. While it is difficult to have a definite answer to the thought experiment, if we look at the 9 companies that were identified as GSIIs, and then look at each of the key themes in this and last year's GMAR, the question comes up whether these themes would have appeared on the radar screen with a pure focus on 9 designated GSIIs. There is likely a disconnect here. In other words, drawing an artificial line largely based on a firm's size is not the most effective tool in addressing the kinds of systemic risks that the IAS has identified in the GMAR. A strong benefit of the holistic framework is its more agile or flexible approach. It leaves sufficient room for supervisors to tailor the framework and policy measures to the specificities of their markets. Or as the CEO of the Insurance Authority of Hong Kong put it nicely at the recent global seminar, the IAS built the holistic framework as a house for me and leaves me with the interior design. I can decide what furniture to place in it. And this means that it offers supervisors much needed flexibility to focus on emerging risks in their markets and at the global level. And doing so would have been much more challenging under a GSII approach. Now, some may be concerned that the elimination of GSIIs is a dilution of systemic risk oversight and wonder whether the holistic framework is sufficient. In response to this, it is important to recognize that although the holistic framework is often described as an activities-based approach, it has core elements that focus on insurance entities, the individual insurer monitoring or IIM, just with the step of designating a specific cohort of firms removed. In other words, there still are significant elements of the holistic framework that filter through and look at individual companies and still has significant elements of entity regulation without artificially identifying who is systemic and who's not. As much as we support the holistic framework over the GSI approach, we ask the regulatory community to be mindful of some of the more burdensome aspects of the holistic framework, including expanded data requests in light of the IIM. I hope these remarks set the scene for a great panel discussion. Thank you, and back to you, Peter.
So thank you very much, Dennis. And that brings us to the panel. I have the pleasure to be joined by 5 panelists, and I'm happy to welcome Astrid Jäkel, COO from Aegon. Welcome. Then we have Renaud Guidet, COO from AXA. We have Martin Meyer, Vice President, Government Affairs, MetLife. We have Xiaolu Zhang, CEO from Ping An, and we do have Yoshihiro Uotani, CEO from Sompo. We will do it in a similar way like last. So we have 5 panelists, so we need to be a little disciplined, but we will make it and get hopefully a broad range of views. I will throw out the first question and you just jump in or indicate in the chat whoever like. Let's keep it lively. So my first question to the panelists would be, you have seen that we have developed this kind of set of macroprudential supervisory tools with the aim to make the global insurance sector as a whole more resilient. And I would be interested to understand what these changes meant for insurers in terms of enhanced requirements on enterprise risk management, greater clarity on the need for recovery and resolution planning and other requirements. So who wants to tell me what the effects were of what we are doing on you in that respect? Just jump in if you like. Martin?
This is Martin Meyer from MetLife. Really glad to be able to participate today. Thank you to the IIS. I think the holistic framework and the structure around the holistic framework, which I would characterize as a collaborative, activities-based approach, is extremely helpful in aiding resiliency of the insurance sector. And if you think of it, looking back at the Great Financial Crisis, one of the issues, one of the primary issues leading to making that a systemic risk was that a whole variety of institutions had limited ability to either measure or manage their exposure to subprime mortgages, right? Caught them a lot by kind of by surprise. And so I think kind of an activities-based approach from the regulators can make sure, and this is really, it's the job of enterprise risk management to be able to aggregate and to be able to demonstrate that the exposures are managed. To the extent that the regulatory approach can mirror how approaches should be managed, measured and managed internally, I think that really reinforces the kind of the ability of the insurance sector and individual insurers within that sector to be kind of resilient to shocks. So to be able to do those two, you have to be able to measure the exposure and to manage the exposure. And if you have a regulatory approach that kind of aligns with those requirements, and make sure that the individual insurers are ready for the next crisis, before it happens.
Thank you. Who wants to come in?
Hi, Peter.
Yeah.
Good evening, everyone.
Hi.
I'm Xiaolu from Ping An. Also, you can make it easier to call me Cecilia or Cici to make it easier. The holistic framework has issued and received and revised a series of supervisory materials and application paper covering potential systemic risk monitoring, recovery and resolution, liquidity risk, and macro-prudential supervision, which provide guidance, which is very important for insurers to take measures to reduce potential systemic risks and also enhance the crisis management. You know that for us, it is quite important to providing a framework as the standard which we can follow. For example, like in China, CBIRC has also issued more detailed regulatory requirements for the entire industry. Institutions as the regulated entity has better compliance guidelines, which help us to improve our own to monitoring the control of potential systemic risk. The regulatory requirements include China issued regulatory requirements for recovery and resolution plans for financial institutions such as the insurance institutions and the banks last year, not only for systematically important institutions, but also for the entire industry to respond to major risks in a more orderly and effective manner. So we do believe that follow up the same standard globally led us to staying just on one page instead of we just follow the different rules and the regulations. So that is our feelings and responding to your question one.
Thanks so much, and good to have your feedback. It's a nice experience for me to better understand what that all means for you. So it's good to have this panel. I think Yoshihiro, you want to comment as well.
Peter. So this is Yoshihiro Gotani from Sompo Holding in Japan. And so in Japan, following the updates to the ICPs and the introduction of ComFrame, the guideline for supervision for insurance company were revised by FSA in Japan to align with this, and monitoring based on the holistic framework has started. So my comment would be a reiteration of what Nicola stated already. So in this monitoring, we have communicated with the regulator, and that has helped to deepen our understanding of holistic framework itself and the importance of group basis liquidity management behind that. So it also helped to give the regulator a better understanding of our risk profile and our framework for systemic risk. So it means it worked well as a communication tool, as Nicola stated. And in fact, in our case, though, that kind of activity gave us ignition for us to revisit or review our current liquidity management framework from the group basis point of view. Of course, we have established a liquidity management framework. However, I would say there is some room to be improved from group management perspective. So I think that there was a benefit of these two, namely holistic framework, which we felt. Thank you very much.
Thanks very much, Yoshihiro. I think what I get so far is very interesting to say that one, we were speaking about activities-based better than just entity-based, but there is also another element I've heard now is that now it seems that the local supervisors are much more engaged and the regulators are much more engaged, and this dialogue gets run, and that helps also to better adapt it. We were speaking about kind of proper implementation according to the market and to react directly to the market, but also this dialogue between the supervisors and the industry obviously is something that is a fruitful outcome of this new approach, because the old one was simply sending the data in and then getting a result which shows you are number 7 or 9 or 1 or whatever. Okay, Astrid, you wanted to come in on that as well?
Yes, so I think for us at Aegon, it's slightly different in the sense that we were one of the GSIs. So many of the macroprudential supervisory tools we've been subject to are still the same now than they were under the GSI supervision. But the one thing I would want to say is that while any additional supervision and any additional requirements, be it around setting up and documenting a recovery plan, be it around liquidity risk management plan or the systemic risk management plan, while of course all of this is kind of additional work, additional documentation, I think I would say that in particular now in these relatively volatile or in these very volatile markets, we are benefiting from all the work that has been done. So if I, for example, think about our liquidity stress test, which has been established as a GSI requirement in many ways, that definitely helps us at the moment in managing our collateral, the recovery plan, while of course, you know, this is looking at more extreme scenario. It is closely linked to our capital management and playbooks around management actions in certain solvency scenarios. So what I find important around these kind of macroprudential tools is that at the end of the day, they are also linked back into the enterprise risk, into the broader enterprise risk management framework, so that you can actually benefit from it in practice. And I think this is definitely one of the advantages we have now, having gone, through the entire process of being required to set it up.
Thanks a lot, Astrid. What comes into my mind listening to you and this relationship it has to the internal risk management of the groups and companies, I think now, when I remember the old system, you tried to change your systemicness, but that did not was not reflected then in the final outcome, because it was mainly driven by relative figures and relations. So I think it's much better also to see the obvious reaction, and that should be the case, that if you reduce your systemicness, then it's less of a concern to the supervisors than if you keep it on the level of the company. So just to say that in case our Nicolas or Dennis, you want to come in on some of the questions, of course you are also more than welcome. Do we have any more intervention? If I don't see at the moment, I have few more questions that I would like to ask you. And the second one would be this idea of supervisory convergence. You know that the IAS has not only approved these standards that are part in supervisory material, that are part of the holistic framework supervisory material, but also issued application papers on resolution powers and planning, on macroprudential supervision, liquidity risk management, recovery planning. I would like to understand what your assessment of this work is, and how do you think has this contributed to the harmonization of supervisory standards at the global level, and could or has already reduced some of the fragmentation we see in the supervisory requirements across the local jurisdictions? So our goal is to, of course, to not only have the standards and their implementation, but also to look for some convergence with the idea of having kind of a convergence of those standards on a global basis. So how do you assess the present status or the future of that? Who might want to comment on that? Just jump in, please.
Happy to take it and to start, Peter.
Please go ahead. Yes, thanks.
Thank you very much for hosting us today. A great discussion. A lot has been said already. So what you may hear from me is more consistency than creativity. I will not reinvent the wheel, because a lot of arguments have already been brought forward. But what I would like to say is that we do welcome, these efforts to harmonize and create a greater convergence between the various frameworks. And we do also welcome the fact that these do focus on recovery planning, and recovery and resolution. Because if we take a step back, I think there are a few messages that we should all bear in mind. The first one is that the next crisis will not look like the last one, the previous one. And I think, that was mentioned earlier in terms of building systemicity into the financial system with a lot of complex and innovative or exotic products. We should make sure that we don't look in the rearview mirror and we don't fight the last war. So we want to prevent the buildup of systemic risk, but the very substance and nature of that risk will not be the same as the one we had to manage in 08, 09. And in our view, and that will be my second message, capital add-ons are definitely not the right tools to address these risks, because sterilizing capital and believing that because you have set that aside, you can forget that and look elsewhere is not the right way to do it. So we do believe, that recovery and resolution planning, proportionality in the way we assess the various risks is definitely the way forward and the way we should work. And this is why, by the way, we do believe that, the development of Solvency II, which precisely is a risk-based framework encompassing the full range of risks that our institutions are to face, is a very sound base and appropriate work. And we do believe that when we speak of Solvency II should definitely be more than and a standard to get which other initiatives should be benchmarked. And the third message I wanted to convey has already been hinted at by a few speakers, but I would like to hint by that not banks. We mentioned earlier the fact that we don't have any maturity transformation risk. Our balance sheet requires the premiums collected upfront and the upfront disbursement or layout.
Yeah, it's very bad. The line has become very bad. It's very difficult to understand you.
I'm sorry. I just wanted to stress some key differences.
Can you just try to fix that, because it's hardly to understand? Yeah.
I will come back later.
Thank you. Please try to fix that. It was very difficult to understand the second part of what you said. So any other views on whether we were successful so far in trying to get some convergence? Okay, it's on my end, obviously, that I couldn't hear him so well. So you got the message. Who else wants to come in?
Me, Peter. A set of application papers developed by IIS on one hand provides further guidance of the policy formulation for regulation, and on the other hand, it prompts globally and effective supervision for the sector. However, we should also pay attention to the differences between countries and markets, trying to avoid one-size-fits-all policy requirements and assessment. In addition, it should be acknowledged that regulators in different countries have different philosophies and legislation, and they also have a better understanding of their own sector growth and risk profiles. Therefore, domestic regulators should be encouraged to adopt more discretionary powers. I have two questions, and I have two suggestions here. The first one is the differences between various countries and markets, especially the emerging markets, should be taken into consideration in the policy formulation and the assessment. For example, one of criteria used to assess the potential systemic risks in collective discussion is trend criteria, which monitors significant increases in indicator scores of individual insurers. However, the sector growth rates, which are highly correlated with the indicator scores, vary greatly in different countries and different markets. The sector growth rate of emerging markets are significantly higher than those of the developed market. Therefore, it is recommended to include the specific market growth rates, such as insurance premium growth rate of each country in the trends assessment to smooth the impact of the normal market growth. And the second suggestion is that new supervisory approaches being implemented have improved the ability of insurance sector to manage the potential systemic risk. On the basis of the holistic framework, we further recommend to encourage domestic supervision over domestic important institutions. As domestic regulators have a better understanding of their own sector growth and the risk profiles, they can formulate more efficient policy measures. It is recommended to give domestic regulators more description, which means under the framework, we probably will have the more flexibilities.
Thank you very much.
I saw a few comments in the chat calling for me to step in again. Can you hear me better now?
Yes, I can. Sorry, it was obviously on my end, at least not on yours. So please continue.
I can see a thumb up from Astrid. Okay, no worries. So I was just, laying out and putting in perspective the key differences between insurers and banks' business model. And I think that's very important that we all bear that in mind. The first one, and this is when I was cut, is obviously the fact that we are not engaged into maturity transformation risk, because as Dennis mentioned earlier, we collect premiums up front and we have, disbursement and outlays further down the road, quite the opposite of banks. The second key item is that while banks obviously have intertwined balance sheets due to the interbank lending, we are not engaged at all into that kind of transactions with each other. I don't lend nor borrow money, from my colleagues here on the line overnight. And the third one is that we don't have, just like banks have with the payment system, any critical function. So I think it's very important as well that we bear in mind that when it comes to resolution and recovery, we should not translate the concept of critical functions, which is very relevant for the banking industry, especially due systems, because it's a very competitive market, almost and on the situation. So you can definitely, I guess I would say, get over, the removal of any given on the market. And once again, that's a key differentiating feature versus banks. So I think all of that means that we should assess the liquidity risk and the resolution pathway very differently from what we do for banks. I'll pause here.
Thank you very much. Thanks. Very clear and very good. So reminds me on the early days, because I was involved in the starting. I want to mention in this when the IS set up this discussion on systemic risk, and it's a long way since then. But I'm very happy to see where we are now as compared to the time 2010, 11, 12 onwards. Any more views on that before we move on?
Yes, Peter, if I may.
Please, of course. Go.
I would also like to try to answer your question on whether we support the process that you have put in place, and the response is yes. I think you have the IS has done a very good job, and in that sense we support the process and the application papers in general. What I would say is that it's really important to keep the requirements, etc., the process as lean as possible. It's important to keep in mind the concept of proportionality and cost benefit aspects, because obviously adding new requirements adds costs. For instance, new elements of data, I've mentioned that, has to be done carefully. It doesn't mean that it should not be done on a case-by-case basis in a qualitative approach, but it's important to avoid in a way, adding data for the sake of it. But the process is a good one. If I may make just a few high-level comments on the different papers, and the reference to proportionality, I think, is especially important in the context of the recovery planning context, as somehow there is a bit of a concern here that some of the requirements may be excessive for some of the companies. And on resolution planning, I would maybe reiterate, I think, a comment by Dennis in his introductory remarks that be mindful of the timing element, the fact that it takes time for, the nature of insurance failures mean that there is a possibility for portfolio transfer and runoffs. But I would stop here, but just to say that overall the response is positive, and there may be things to keep in mind for the future reviews and future work on those issues.
Thanks very much. So I suggest to move on one more question, and then I invite others. Might be you can also come back to some of the issues we have done. So I want to know what your experience is with the new supervisory approaches as soon as they are implemented. Have they already, or will they improve the insurance industry's ability collectively to manage systemic risk and strengthen the financial stability of the insurance sector? And what do you think is the key difference to the GSI methodology in that respect? So do you think that because the ultimate goal is really to contribute to global financial stability and to avoid the building up or mitigate the risk, building up of global systemic risk, and that makes it so difficult because we need to have this global view. Do you think that's something that we see here? I mean, Yoshihiro, you want to say something about that?
Very much. So this answer would be some part for the your question 2, and I agree with Renaud's comment that there is a big difference between banking sector and the insurance sector, and Cecilia's comment, there is a difference in market, country, jurisdiction. However, I value that this news framework created a common language for the harmonization through the holistic framework. So for us, as with many insurers, so our group is increasingly global in its outlook, and the degree of harmonization in supervision is welcome, as it helps us to manage our business portfolio on a consistent basis, and in ensuring the level playing field for global competition. So I value this activity in terms of creating common language, and yeah, so I think this is a very positive aspect of these activities. Thank you very much.
Thank you, Yoshihiro. Who else like to share their views on this impact that already had or will have on really the collective treatment of the systemic risk on a global basis?
Happy to, Peter.
Please come in.
Yeah, I think I will definitely echo the view that was just articulated, which is that we really saw the adoption of that holistic framework by the IAIS 3 years ago now as extremely positive, and a move in the right direction. And then obviously its endorsement by the FSB, and we do believe that it will help us, fix what was probably missing or even flawed, in the prior, systemic individual designation, and we had pointed to those various flaws in terms of assessing the systemicity based only on size, and if anything it showed that insurers would not move the needle massively enough to be systemic in terms of the impact on the financial system. And then also we need to recognize the counter-cyclical nature of the insurance business, which is mostly buy and hold, not constrained by liquidity, and able to act as a buffer in times of stress. So we do believe that the holistic framework is fundamentally a much more fitting approach to identify, to monitor, and to mitigate sector-wide developments. So we do welcome it, and we do support it, and we do believe that the prior individual designation system should remain suspended.
Thank you. So that is, of course, the ultimate goal, that the new system should replace finally the old one. So that's why we are working so hard, and it's important that's why all this I mentioned, the baseline assessment. So we have the supervisory measures that should be credible per se, and then we need to look into whether the implementation is fine, because it's no longer a system where data come in the IS or somebody else is calculating things and then come up with a ranking or whatever. It's more on based really on the implementation in the different jurisdictions and how this is put in practice by supervisors. Actually, that's why this. But I'm happy to hear this. This has initiated a lot of good side effects, so to speak, also on the relation between local supervisors talking to their groups on those issues. Who else on this one? Yeah, please.
Let me jump in here.
Sorry, Martin, and I think then also, was it Astrid, or who was it? Oh no, I think, yeah. Go ahead, Martin.
So, yeah. Okay, thank you. So I think we've already seen several important instances that the holistic framework having a clearly superior ability to kind of manage systemic risk. We've already seen that through COVID. That was certainly not something that could have been managed through a GSI approach. We're seeing that also via climate and cyber risk management, and the ability to kind of get our arms around those two approaches. I think there's even a far greater potential for the future for this to reduce systemic risk and increase knowledge across industry and regulators. Taking this kind of a collaborative approach. Let me just point very briefly to the NAIC's macroprudential initiative, as an example of that. Several years ago, and that macroprudential initiative takes a very similar collaborative kind of activities-based approach. The NAIC decided to look at liquidity risk several years ago. The first thing that they did was they wanted the regulatory approach to kind of mirror best practice in the industry. And so what they determined was that the regulatory approach would use what's called the cash flow projection, liquidity stress testing. So that's what they based their framework on. Then in discussions with industry, one of the things they wanted to do was, figure out what scenarios to use. And of course, the base scenario is the great financial crisis scenario. But we wanted to have a second scenario that was hopefully complementary to the great financial crisis. So what we came through, and that was a very collective discussion with industry. The second scenario would be, and this was back in 2019, 2018. The second scenario would be what's called the spike scenario, which is a sharp rise in interest rates, as I said, complementary to the great financial crisis. That was a scenario that needed to be kind of further developed because it hadn't happened in so long, since the 1970s, early 1980s. So it took some work to get that, to get that scenario implemented. But that was we did that work. And then what we found, the first range of field testing was done using data as of year-end 2020. It was done in 2021. A couple of pleasant surprises out of that field test. The first one was because the regulator and the industry had kind of aligned on what the approach should be. It was relatively easy to provide the macroprudential information to the NAIC, which what they needed to see was asset sales under stress. And that was actually kind of an output of the kind of internal models that companies had used. One that we didn't generally collect or analyze on an individual basis, but it was important information for the regulatory purposes. So we didn't need to create a whole separate kind of regulatory framework. We had one that was already aligned with industry, and so it was actually relatively low cost to provide that information, right? And the second information that came out of that was that almost half of the respondents, the volunteers in that effort, they were about 22, 23, noted that new spike scenario that had been developed was their most kind of problematic scenario. So if you think of that from a regulator perspective, that's a scenario that could potentially cause a systemic issue because it affected such the broadest range of companies. So I mean, there were a number of positive things that came out of this approach, right? So the regulator received more accurate and higher quality risk management information because they were using best practice approaches, much better than they could have achieved under the GSI. Right? The regulator was able to analyze that non-traditional stress scenario, the spike scenario, which had a broad implications across the industry. And the third one is kind of by taking industry best practice, they were able to incentivize all players in the industry to kind of adopt that best practice. So it made the entire kind of industry more resilient by raising the bar for the entire industry. And then the fourth one was completely unexpected, which was we actually had a mini spike scenario occur this year, right? And it was mentioned at the outset that inflation risk being one of the major risks in the industry and something that we haven't been used to for a very long time. But because we had developed that scenario, we actually already completed a field test of that. That not only the industry itself, but the regulators have a lot more information on what the implications for that scenario would be even before it happened. So we were able to manage through that crisis, I think, a lot better, at least from a liquidity perspective, because we had gone through that exercise. And I think that same structure of exercise that appears to be adopted through the holistic framework could lead to those types of benefits going forward on a global level. Thank you.
Thanks again. A fantastic example on this, what's going on a jurisdictional level and what's going on a global level and how that is interlinked. Thanks very much, Martin, for that. There was it Astrid or Cecilia who wanted to come in?
Oh, yeah. Comparing with the strong supervisions of only 9 GSII insurers, the implementation of the holistic framework and GME is more effective in identifying the sources of the global systemic risk. So making it short, we strongly agree that the new supervisory approaches being implemented have improved the insurance industry ability collectively to manage systemic risk and strengthen the financial stabilities. We fully support this. This is really the holistic framework is more effective comparing with GSII. Thank you.
Thank you very much.
If I can,
yeah, Astrid, please go ahead.
If I can add to that, so for me, the strength of the holistic framework is really, I mean, first of all, that it is applied more broadly, and we've already said that today. But in addition to that, I think it's also, it provides more room to look at the risks that as an industry, we don't look at systematically yet, or at least not consistently across all geographies. So if we look at the old framework, it was in many ways focused on risks that are already covered in other standards like Solvency II, mark-to-market approach already covers a lot of the financial risks. Yes, of course, there are certain aspects that may be less well covered, like liquidity, but broadly, financial risks are relatively well covered. But then if we look at non-financial risks like cyber risk, like changes in climate, etc., that can also have a systemic impact, I think the holistic framework provides more flexibility to also cover these types of risks. And I think that is one of the real strengths of the framework.
Thanks. Very encouraging. Thanks for that feedback. Anyone else? Otherwise, I just try to move to one more question. Yeah, please. Yeah, Dennis, please.
I would like to just add to Martin's point here. I mean, the benefit of the holistic framework versus GSII, and I think that is really collaboration. I mean, an activities-based approach by nature requires active industry involvement because you're getting into details of activities which regulators or supervisors may not get all details about on their own. And I think these interactions raise the expectations for the entire sector, as not only insurers have to push the envelope, but regulators also need to understand those approaches in that sense. So I think that generates valuable information, and it also causes the holistic framework to be more superior over the GSII designation. I think because of the GSII is really top down and very much it's up to the regulators and supervisors without much industry input to decide what is important and systemic. So I think they're missing out on a lot of important information when just focusing on sort of following the GSII approach. I just wanted to add that to that point made by Martin and colleagues here on the panel.
Yeah, thank you very much. I think it's what comes into my mind is also this. Because you say for the supervisors then to decide what is the systemic risk, you get a lot of data in the old system, and then you have some kind of model where that you apply. But I mean, given what has happened over the last 2.5 years globally, I mean, we would never end up in designing such a model where we can then apply for 1 year. So this flexibility becomes for me an inherent part, and this approach to exchange views on what do we see growing in order to timely respond to that. Can we then move? I want to know when we have a few minutes more left. I want to know, you have seen that we published the results of the baseline assessment. That was the first step. We did that last year, and beyond, and we are now in the process, as I said, to do the more targeted jurisdictional assessments. We are going on with our global monitoring exercise regularly. My question: where do you think that there is sufficient progress being made in implementation of this macropotential framework and these tools? Do you think some areas are more advanced than others? What is your feedback on that?
I'm happy to start, Peter, on
ahead.
that one. Thank you, and I hope you can hear me properly and loud and clear. I think in our view, that goes in the right direction, and we're very happy to see that the progress, done in the implementation, the holistic framework, at least speaking, for Europe, and happy to see the level of engagement of the industry with the supervisors. Like to draw the attention of the audience, which is the importance of supervision functionality, when it's important the because obviously, which is to say, well, it is anything to add to the list of data that is requested, but ultimately, it just gets sedimented and it balloons, and the annual data collection exercise becomes super granular. And with the scope expanding every year, you end up with something which looks to go beyond what is strictly necessary, or to be justified by the holistic framework itself. And I do believe, that we live in an information where we don't have to face a scarcity of data, we have to face information overflow. So I don't think it's helpful anyway, to collect more data, because then it gets dilutive. It would be much better to be focusing on what really matters, rather than having the kind of delusional comfort to believe that, we got more data, so we are safer. I don't think that goes in the right direction. So very practically, what I would recommend is that going forward, any changes or any additions, to the individual company data requests should only be made after a stringent and thorough analysis of the existing data points, to make sure we don't reinvent the wheel, and a full substantiation of the fact that they are needed.
Thank you. So I think that was mentioned also before several times. I think that seems to be a big issue on the data. But of course, we need, and I'm happy that you all that mentioned data did not say, do not ask for additional data, but if you ask for data, then be aware of what data you ask precisely. And that's good, because we have this ongoing dialogue on seeing where should we focus on. And then if we have some common understanding on where those risks could potentially build up, we also might easier get an understanding on which of the data and what data we could possibly collect to understand better on how big these risks are and what the measures are to take. Anyone else to comment on that? So the question of how you think the progress is now, can you witness progress on that in the application as insurers, as insurance groups?
Peter, if I may, just want to react to that question. I think it's difficult for me to evaluate and judge the efforts made by regulators and supervisors to implement the holistic framework. But I think it's fair to say that the IIS, along with the supervisory community, has made a lot of progress in developing and work on implementing the macroprudential tools that are part of the framework. There's been a lot of engagement with the industry, through consultations and discussions and roundtables such as this one. I just wanted to point out, I think that is very, very positive. But I leave the comments as to the actual implementation to others.
Okay, so it should not be. I didn't ask particularly groups to criticize potentially their own supervisors, but just wanted to understand where you see that, because we have to have, at the end of the day, a critical view, because the FSB will have anyway on really that does work, and we concluded from the baseline assessment, and expecting some similar outcome in the ongoing assessment, that good progress has been made. Of course, we need to keep in mind the holistic framework was finally adopted in 2019, so it not all the processes work that quickly, but I think there, at least as we say, there is a lot of let's say enthusiasm to move that on, and ambition to move on with that, because we firmly believe this is much superior to the existing old system. Any more remarks from your side? Just jump in, please, if you like.
Hi, Peter.
Yes, Cecilia, please go ahead.
Yeah, I'm not going to comment on the progress. However, I just really want to give some observations on the benefit as one of the key elements of the holistic framework. The implementation assessment create a lot of value. Actually, I think two words is very important. Two words are very important. One is collective, and the others is harmonization. And collective, my observation is more communication. For example, as in China, normally, as the insurers, we don't really like to talk to the regulators directly. When we talk, sometimes we just think about the issues or the problems of ourselves. However, when implementing the holistic framework, particularly the implementation assessment, and we just believe we as just one team, the regulators and the institutions, we care about the indicators and the systemic risks. So it creates a lot of opportunities for us to understand each other's, putting ourselves into the other's shoes, and we communicate more and more. I think that is very important, not only for domestically, but the global wise. Like, for example, this evening, we get together and talking about the 3 key elements in the holistic framework. And also we care about the implementing the assessment. So the communication is good. And I believe the purpose of this is that putting everyone from the worldwide into just the one framework, one standard. And we also follow, and we also have the flexibility. However, we work as a team. So that is very important. That's also my observation. And the harmonization, the more communications, the more understandings of each other's, I think that is possible for us to make the world more harmonized. Thank you, Peter.
Thank you very much for that. I may say that the audience, people are invited to post questions or comments in the chat. We have a few minutes left to take them on. As long as there are no in the chat, anyone else from the panelists who wants to something to say on this final point?
Maybe just one comment on the baseline assessment. So I think from my perspective, the baseline assessment also gives some comfort that the main geographies we are active in, and also Netherlands, where our lead supervisor or group supervisor sits, are actually quite advanced in kind of implementing the measures related to the holistic framework. So that was our gut feel, and in a way this is what the baseline assessment also says. So from my perspective, it also kind of gives comfort that we are on a good track, and that we, you know, shouldn't expect too much additional measures, or that basically it's largely implemented, and not a lot of new things will come.
yeah, let's hope. Let's see. Make progress with this type of implementation. That's now our current goal, to see from the IS side that this is properly implemented. And I think about that. I'm happy to chair this panel, because also it means that the implementation assessment side has come into much more into that. There was a long time when we were discussing the holistic framework itself, with a lot of rounds of discussions, round tables, and now we are at quite an advanced stage where we not only say it has been approved and adopted, it has also been implemented, and good progress has been made, and we are in a status to say, look, we even carefully look on how this implementation process has taken place and is going on. Anyone, any final remarks? I do not see any question in the chat coming up. So then let's conclude. I think perfectly on time. I think we would have time probably to discuss much further. I thank you particularly for the insight you gave to me, and I think to others, on how it's perceived, the work that we are doing is perceived at the other end, so to speak, how you see the progress made, and whether you still think that the holistic framework has been a good idea and is still a good idea. I have also noted, of course, the caution that was put particularly on data and burden, and of course the call for proportionate implementation. That is noted, of course, and it's good. You might say it here and there, but we try to do our best to make this really a success story. With that, thank you very much again, and I hand back to Vicky.
Thanks very much, Peter. And thanks also to Dieter for chairing the first panel, and thanks to all the panelists and to all the participants for the contributions. I'd like to conclude with some kind of broad takeaways from this rich discussion. So from the stakeholders, I mean, the first takeaway is that there seems to be broad support that the holistic framework is a better framework for assessing systemic risk than the previous entity-based approach with the methodology that we have to devise entities. There has been sort of a variety of views on which element of the holistic framework might be effectively more useful, with some stakeholders and some panelists focusing more on the activities element, which we call the sectoral approach, where we identify particular macroeconomic themes, and then we look at sector-wide exposures across the industry and discuss the extent to which these exposures could lead to risk. But I think there is also support and understanding that if these exposures are concentrated on individual insurers, or there are other elements that suggest that individual entities could potentially pose a systemic threat, that also justifies the approach that we have taken, which is also to collect and look at individual entities as well, not in order to label them as on a list that identifies globally systemically important insurers. No, we have moved on from that, but to actually look at the entities and see whether they have concentrated exposures of the type that we care about, or that pose potentially risks, and have a rich supervisory discussion with their specific supervisors about their approach, how they're mitigating any potential risks, what they understand, to ensure that there is a globally consistent and appropriate response. So that is my first takeaway. My second one is that there is agreement that particularly the global monitoring exercise provides a helpful global perspective on risks and trends. I mean, it was said, I think it was Nick that might have said it, that that it provides you with a tool, with a framework, with a process, which you can deploy when and as you need it to actually do a proper risk assessment. And we did that for COVID in the first year of the GME, but also it gives you a rich source to actually then have the proper discussions among supervisors, but enriched also by the feedback that we have in the process from the CRO roundtable and from other sources. There was also quite a bit of support for the way that the GMA reports on climate, and now we're going to have on cyber, actually do deep dives on potential sector-wide exposures to risks like climate or cyber as part of the whole sort of global monitoring exercise process. Third, there was support for the additional macro-pru policy tools we have developed to make the global insurance sector safer. And there were several examples provided by panelists of individual jurisdictions implementing the approach that we put together on supervisory requirements and policies, for example, on liquidity risk management, and in individual jurisdictions, and several examples about other jurisdictions and what they have done that suggests that the standards we put in place in 2019 are making a difference on the ground. So these are my key takeaways. There were also some issues that were raised that broadly speaking, we were well aware of, and as Peter and Dieter said, that are noted, particularly on data and proportionality, which is an issue that has been raised throughout the process. I mean, the standards themselves, the supervisory requirements and the policy measures are proportionate and subject to the proportionality principles. Themselves, the data is a challenge, and we are seeking, of course, to collect data that is relevant and necessary for us to do properly the risk assessment and to identify potential sector-wide exposures and other exposures to systemic risk. And we are conscious of not constantly expanding data requests, but this is an issue that we need to keep considering, and also aware of the fact that there isn't a standardized, globally consistent template for collecting these data, in part because we haven't yet, as Dieter said, have a sort of globally consistent approach to capital requirements, or indeed we are in the implementation phase of IFRS 17, and even IFRS 17 will not apply to every jurisdiction in the world. So this is what I took away, but overall a positive message from stakeholders. Now, what is next? As I said in the beginning, and as already mentioned by Dieter, what's going to happen now is over the course of the next few months, we will be drafting our assessment of how well the holistic framework has fared. And your feedback will feature into this assessment, but of course the assessment will have many other elements, including of course the implementation progress of the various jurisdictions in applying the supervisory requirements that I mentioned, which we are in the process of finalizing through the deep dives. As we are drafting this report, we will continue to welcome feedback from stakeholders. Later this year, at meetings that are going to be happening in the autumn with the FSB Standing Committee on Supervisory and Regulatory Cooperation, the SRC, and thereafter, the plenary, the November meeting of the plenary of the FSB, the FSB will decide, of course, in consultation with us, and after having considered our assessment, whether to discontinue or re-establish the annual global systemically important insurers, GSII identification. We, of course, we're going to be providing a recommendation to the FSB based on the progress made, and it would be for the FSB to decide what they want to do, but on the basis of the information we're going to give them. And in response to a question that was raised, whether the FSB recognize the approach and the differences between banking and insurance. I mean, we have been updating the FSB annually since we adopted the holistic framework in 2019. But it is fair to say that it is this year that we're expecting the most substantive discussion, because it will be the final, if you want, report. So with that, let me end by thanking everyone for joining and contributing to the public session. It was very good of you, and it was an interesting and rich discussion. In a minute or two, we will also be having a separate session with representatives from the authorities, the regulatory authorities, to discuss the conclusions from today. If you are such a colleague, please stay on the line. In the meantime, I will bid goodbye to our stakeholders and thank you again.